Okay, so how many of you guys like making money? Everybody. And how many of you guys like finance? I don't see a lot of heads rolling right now, right? So, to make money, you really need to know some part of finance. You really need to know, apart from getting your salary, right, there's a different thing of allocating your money towards different asset classes and how you can make maximum returns. Everyone knows fixed deposits, right?
Yes.
So every country, the fixed deposit is different, but obviously you get the lowest return on a fixed deposit. And anyone knows why you get the lowest return on a fixed deposit?
Because it's the safest way.
Correct. So your risk is the lowest. So to make money, to make returns, you really need to have a good risk appetite. And to have a good risk appetite, you need to have a good background or a good base of finance. And the place where you can get returns above fixed deposits and above your bank deposits, it's obviously the stock market. And the stock market is the place where people lose a lot of money and people make a lot of money. And obviously, Warren Buffett has made 99.9% of his wealth from the stock market. So I realize that all you guys are planning to start investment funds. So I'll just start my presentation and tell you, how do we look at companies? How should we analyze companies? And the different types of ratios that we use, the different types of words that we use in the stock market. What is a balance sheet? What is a profit and loss statement? And I'll just give you a small brief of what I used to do when I worked. So what type of modeling we used to do. So all this will be, people who have a little finance background, this will be easy for them. But with people with a clean slate, this may go over your head like a bouncer. But don't worry, it takes time. But finally, we all want to make money. So our end goal in life, not our end goal in life maybe, but our post our graduation, we all want to make money. So how many of you guys buy phones, right? I'm sure everyone buys their own phone. So anyone can answer, when you buy a phone, how do you choose the phone that you want to buy?
Doing a research
Yeah, so what type of research do you do?
about characteristics, about the brand, about the stability, about the OS, and so on and so on.
So do you also you look at the features and then you'll compare the prices of your phone, the phone that you like, with other phones?
Yep, that's correct.
So this is the first part of investing. It's called relative valuation. You compare the company you're looking at with companies that are there in the market. So same way how you're buying a phone, you always look at the price of your phone and compare it with phones that are there in the in the market. And that's one way to look at a business. So I'll just share my screen so that you'll get a better understanding. Okay, so I think everyone can see my screen.
Yes.
Okay, so I'll start with what I've been doing. I'm a GMBA batch of 2022. I've been trading in the stock market and investing in the stock market since I was 17 years old. I'm 26 right now. So like how you guys are in your undergrad right now, in my undergrad, I was actively investing, and I used to use all the money that I make in the market as my pocket money. So I never used to take money from my parents. I used to just take that money and spend it. So I could buy clothes that I want. I could buy anything that I want. And the next thing is, I worked as an analyst at an investment fund, and wherein I used to look at stocks, look at the stock market, I used to look at businesses, perform different models, perform different valuations. And before that, I worked at CNBC TV 18, where I was 21 years old and I used to come on air. CNBC TV 18 is India's #1 business channel, wherein I used to come on air and talk about different stocks and different sectors. So that's a brief about me. I'm a stock market junkie. I like making money. Right now, money is in my blood. So don't judge me, guys. But finally, it all boils down to how much money you have in your bank account, and you can invest, trade, do whatever you want. Money is not the key to happiness, but it's always better to be happy when you're rich than be sad. So this is the basis of what you do when you enter the stock market. You look at different financial statements, and there are three main financial statements. One is the balance sheet. The second is the profit and loss. If I'm going too fast, please let me know. I'll slow down. And the third is the cash flow statement. So there are three things: balance sheet, profit and loss, cash flow statement. So we will focus more on these three things, and we'll just see how do we interpret these types of statements. And once you learn to interpret these statements, you can actually understand how good or how bad a company is doing. So I'll start the balance sheet. The balance sheet provides you an actual picture of what the company is doing. What are the company's debt, what is the company's equity, and what are the company's assets. So all these things help you to understand how good the company is and how solvent the company is. So I hope all of you all are up to date on current news. Is everyone up to date on current news? So there's this company in China called Evergrande, which is currently bankrupt, and this is affecting all the markets globally. So how do you know companies bankrupt is when you'll see their balance sheet. You'll actually see that the debt that they have on the balance sheet may be a multiple of their assets. So it must be more than 10 times, 15 times their assets. So if somebody wants to recover money from these companies, they have to sell off their assets, but they don't have enough money or enough assets on the balance sheet to sell it off. So this will actually tell you if the company is solvent or not. So the balance sheet tells you about solvency. Moving on, there are different, the balance sheet provides a snapshot of what a company owes as well as the amount in. Shareholders are the people that put money into a company. They're always you can call them the guys who have the share of the profits of the company. So why it's called shareholders? Because they have a share and they hold the company. They have a stake in the company. Warren Buffett, why is he, worth, maybe what, 70, $80 billion? Because he has shares in different companies. The value of those shares keep going up, his net worth keeps going up. Same with you guys. If you invest in the market, if the market goes up, your net worth goes up, you make money, you spend that money. You don't need to depend on your parents. You can fund a lot of things in life. So moving on, in the balance sheet, there are four different things. One is the current assets, the current liabilities, the current non-current assets, non-current liabilities. So when you look at your current assets, the cash and short-term investments, these are investments that are there in your bank account. You have cash, like how you guys have cash in your own bank account, that is your cash and short-term investments. Second thing is accounts receivables. So when a business is selling their products, the customers owe them money. So if the customers don't pay them on time, it comes under something called accounts receivables. Accounts receivables is something that you always have to track on the balance sheet. And these four things that I'm giving you, you just have to go through four of them and look at it in a balance sheet if it's high or low. That's all you have to do. Short-term loans and advances are the loans that a company gives to say its subsidiaries. Subsidiaries are say a sister of a company, or the loans that gives to its customers. And finally, inventories. So suppose Apple, for example, Apple is manufacturing an iPhone, correct?
Mm-hmm.
Your silicon chips, you need
Yes.
screens, you need cameras. So you need all of that. So all that you keep in something called your inventory. So these four things are very important to track in a balance sheet in your current assets. Moving on, these are non-current assets, something that are more than 1 year on your balance sheet. So these are your long-term investments. Apple, for example, has factories. In these factories, they have to build these factories. So factories obviously are for more than 1 year. And then plant and equipment again is a very similar thing wherein you need to build factories. In those factories, there are machineries, and finally, it's your land. So there are these three things to track in a balance sheet under non-current assets. So, I just hope you're noting this down, because when you look at a balance sheet, it becomes very easy to understand, what is there in a balance sheet and what percentage of the total balance sheet these things are. And this will help you in your first step towards analyzing the company, whether the company is bankrupt or not. Moving on, your current liabilities. These are liabilities that you owe to someone. So these are short-term debt that you owe to the bank, and these are customer advances, the advances that the customer gives you. Why is this a liability? Because you have still not delivered your goods to the customer. The customer has given you money upfront, but you're not delivered the goods to the customer. So these two things are important to see in your current liabilities. Moving on to your non-current liability. Oh, what just happened? So non-current liabilities are liabilities that are more than 1 year. And the most important thing is your long-term debt. For example, Apple. Apple doesn't have any debt on their balance sheet. So when you're looking at Apple, you'll see, okay, there's no risk, there's no long-term debt. The risk is much lower compared to a company which has a lot of debt. So if you can just Google a company called Evergrande, which is a real estate player based in China, this company is almost bankrupt currently, or is actually bankrupt. They cannot pay the interest on their debt. They cannot pay their debt. So this is one thing you have to track in a balance sheet of companies, the debt. It's very important, and it's the same for all of us. Like if I'm doing an MBA, I've taken a loan from the bank to pay the college. So it's a debt for me. If I can't repay that debt, I'll go bankrupt. The bank will take my assets. So this is very important for all you guys to remember. Always in your personal life, also try avoiding debt, because debt is a very dangerous thing. If you can't pay it, it turns your life upside down. Same for companies. If they can't repay their debt, it turns their whole company upside down and the company goes bankrupt. Now, this is an income statement, and this is a very, you can call this an income statement. This is a different types of headings that are there in the income statement. And when you're analyzing a company, you will look at its income statement and look at, first thing is top line. Top line is the top thing, is called revenue. You look at the revenue and say, okay, the company is doing well. Is the revenue growing? That's one thing you look at. You look at the trend. Always look at the trend when you're looking at a profit and loss statement. Is the revenue growing? Then moving on, raw materials. Apple, to make up Apple product, what do you need? You need silicon chips, cameras, you need your screen. So these are the raw materials. And you minus your revenue minus raw materials plus minus your stock adjustments. Ignore that, that's not important. And finally you get something called your gross margins. Gross margins are basically your revenue minus the goods that you use to manufacture your product. So that's called gross margins. It's always very important to have positive gross margins for any company, and it's always important that these gross margins are growing. So always look at the gross margins. The gross margins are high, that means this company is doing something well. They have pricing power. Apple, for example, has very high gross margins because people like you and me keep on buying Apple products. So that is why they have high gross margins and they have pricing power. Now, if you compare Apple with Samsung, Samsung product prices are lower. So obviously the gross margins will be lower. Apple on the other hand will have high gross margins. Now moving on, there are different expenses that a company incurs in running their business. There's power and fuel, manufacturing expenses, and one of the most important things is the salaries that you pay to your employees. And once you minus all of this from your gross profit, you get something called EBITDA. And this is one term that you really need to know if you guys ever want to look at a company or ever want to analyze the stock market, because EBITDA is one of the most important things that we look at in a company. It's the operating profits, also known as earnings before interest, tax, depreciation, and amortization. EBITDA is one thing that the margins need to keep on improving. And if you can see in this company that I've given you, in 2011, their EBITDA margin was 18%. And in 2015, it's come all the way down to 13.7%. So then, I'll say, okay, why is the margins coming down? It's almost a 400 basis point, 500 basis point. That's 5% lower than, 4 years back. Then I'll go and I'll see what is their power and fuel expenses, their employee costs. Where are these companies having you minus all of that, you get something called profit before tax. Again, profit before tax has to always be increasing for any company, but in the company that I'm showing you right now, the profit before tax margin has come down from 12% to 6%. Now you look at this and say, okay, what is the company doing wrong? Now this is where your analysis comes in. As you guys, you have to go dig into the business, understand what the company does, what are their main raw materials, what is their main product, why is the company doing bad. You have to understand all of this. And all of this takes a lot of time because you really need to go in depth into a company. If you're studying Apple, you really need to study Apple, understand what their products are, where do they procure their products from. All that matters in the income statement. All this shows you what the company is actually doing. After profit before tax comes the tax, and finally comes your profit after tax. So this is just a general income statement that you have to read whenever you're analyzing a company and see the trend. Is the trend going up? Is the trend going down? If the trend is going up, why is it going up? If the trend is going down, why is it going down? If you have any doubt, just stop me in between, okay, guys?
Okay.
So some terms used in investing. The first is your shareholders. These guys are owners of the company. So for example, SP Gen will have shareholders. There are these guys who invested in SP Gen maybe 3 years back, 10 years back. Nitish Jain, for example, will have a substantial share of SP Gen. He's a shareholder of SP Gen as well as 90% of SP Gen. So these are your owners. Now moving on to revenue, as I told you, it's the money that your company makes on the top line. Your gross profit minus revenue is minus goods. Get that. EBITDA, as we already explained to you. Market cap. So market cap is a very important thing. Why do we say companies like Apple, companies like Tesla, their market cap reaches trillions of dollars? That is the worth of the company. The worth of the company means the company on the stock market is worth so many $trillion. So if you see Apple, you have Amazon. Why is Jeff Bezos worth 50, 60, 70 billion dollars? Because he's a shareholder of Amazon and he has a percentage stake in Amazon. So when you have a percentage stake, you have the market cap or percentage of market cap, which is your net worth. So that is the worth of the company on the stock market, which is again a very important thing to know. So when you're looking at a company, the first thing you look at is the market cap. How big is the company or how small is the company? Now, in different countries, the definition is different for market cap. For some companies, for small countries, market cap may be too large, market cap may be too small. So you have to always balance this. And going forward, we'll learn more about market cap and we have some other sessions if we do. Dividend. So dividend is the amount a company distributes to its shareholders after its profit. So this is a very important thing to see, a thing to see if the company is giving dividends to the shareholders. Nitish Jain, for example, so SP Jain makes a profit because all we pay our fees to SP Jain, they make a profit. Now, after they make a profit, do they want to give dividend to their shareholders? That is to Nitish Jain. So after they make a profit, they'll give some money to Nitish Jain saying this is a dividend. And price, this is the price, Tesla, Amazon, all these companies trade at different prices. The prices keeps going up and down, and this is also one very important thing to track when you buy a stock, the price of the stock and what price. You guys are aware of, what's going on globally in India or in your countries. A lot of IPOs are coming out. An IPO is an instance where the company lists on the stock market for the first time. These guys are listing on the stock market, they're giving their to the public, and this is one thing to keep an eye on. And so I'll skip all of these, but we'll easily understand these different ratios and how important these ratios are. And as we explained, like when you're buying a phone, how you look at the different features, the same thing in balance sheet is you look at the different features. You look at Amazon versus Tesla, Apple versus Walmart. You look at these different types of features, and these are known as ratios. Now, profitability ratios, these are different types of percentage of sales that you use. Again, all these ratios are used to compare your company with another company. And you have to see whether your gross profit ratios are high, your operating margin ratio is high or low. And you need to find out the reason why is it high or low versus another company. So these are some of the ratios that you use, and there are millions of ratios that you can find on the internet. But these are some of the most important ratios that we use while we analyze a company. And now finally, valuation ratios. These are ratios that you again use to compare your company with another company. And as we explained before, market cap is the total worth of the company divided by the profit after tax. So it's called a PE ratio. And with the PE ratio, you use it to compare with other companies. And again, you'll find it whether it's low or high, and why is it low or why is it high. So strong companies have a high PE ratio. Tesla, for example, has a PE ratio of 1000. So a P ratio of 1000 versus a normal P ratio of 20, 30, you need to find out the reason why the P ratio is so high, because Tesla is growing, they're doing very well. Now you use this to compare companies in the same sector, and the different types of valuation ratios that are there. EV, EBITDA. EV is known as enterprise value. EBITDA, obviously we know is earnings before interest, tax, depreciation, amortization. Okay, so all this may go as bouncer for you guys, but this is important. When you start analyzing a stock, you will understand more into this. You go more in depth into this. This is just like a bird's eye view of things that you have to look at when you analyze a company. So this is a financial summary of a company where you'll see that the whole revenue is given, the valuation ratios are highlighted, how you have to look at it, the operating ratios, how you look at, and these are different types.
Yeah, connection.
Sir, you're frozen.
Now, can you hear me, guys?
You were frozen for a bit. Can you repeat that?
So I'll start with this slide. The slide is there right now. Right? Can you hear me?
We can see the slide, sir.
Okay, all good. Everyone can hear me now. I think my screen is frozen as well.
You could try and leave the meeting and join back, and hopefully that solves the frozen problem. Yeah, I think we're having some technical difficulties. I hope he just.
Hey, can you hear me now? Is it good?
Yeah, it's perfect. Much better. You can continue. You can go ahead. Sorry.
Is this fine?
Yeah, we can see the screen. Yes.
Yeah, can you hear me as well?
Yes, definitely.
Okay, so I'll start with the financial summary. I hope I'm not boring you guys because numbers actually is really boring for some people. So this is just a financial summary of a company, how it looks like. You see the sales, you see the net profit, you see the EPS, which is the earnings per share, you see the price to earnings, you see the EV beta. So these are different ratios that you use, which you'll use in your analysis going forward. Now, this is one very important thing that you need to know, and this is what every investor uses, and this is what Warren Buffett actually calculates in his mind when he looks at different investments. It's called DCF, it's called discounted cash flow. This is actually a concept that I hopefully you all will learn, and it basically finds a present value for future stream of cash flows. What are future stream of cash flows? In short, the profits a company makes over the next 10 years. So what you try to do is you try, analyzing the company and then predicting what the next 10 years profits will be. Then you take those profits and you get it back to current value. And how you get it back to current value? You use something called a discount rate. A discount rate is basically the type of return that you want from the returns you're planning to get from this company. For example, in a fixed deposit, you're going to get 4%, 5%. But when you're investing in a company, you're targeting maybe 16 to 17%. So basically, discount rate is the return, your targeted return from a company you're trying to make that you're investing in. Now, the discount rate is derived from something called a weighted average cost of capital. This is again a little complex concept wherein weighted average cost of capital, the interest cost that you pay and the cost of equity. And going forward, once you read about this becomes much easier for you. And this is a DCF model. Has anyone heard of the company called Nika? Any of the girls over here heard of this company called Nika? Anyone in India? Okay, so Nika is a beauty product company that sells beauty products online. They're an e-commerce website like Amazon that connects the buyer and seller. And what I'm currently doing is I'm making a DCF model on this company called Nika. And as you see, I've actually predicted the revenue for the next 8 years, the EBITDA, the profits, the FCFF, which is known as free cash flow. So I basically predicted how this company is going to grow over the next 8 years, and that is my main analysis comes in, wherein what the company does, how does the company make their money, where does the company make the money, which type of customers do they sell to, which type of market do they deal in. So you analyze all of that, and then you have to put it quantitatively in your numbers to try and understand how the company is going to do over 8 years. So this is just a gist of what we do as analysts. We try predicting the next 5-6 years and we discount it to current value. All this is little humbug because when I was your age, I also didn't know all this. But it's very important to know this. The earlier you know, the better. Now, when you're investing, when you guys are looking to invest in a company, the first thing is you look at the industry. Now, we'll take Tesla for example. Tesla is in the electric vehicle business. You will see how the electric vehicle industry has been growing the last 5 years. And by analyzing the industry, you will try predicting how it's going to grow over the next 10 years. So that is one thing you will do, and you will look at different competitors. How are they doing? What are they doing? How are they different from Tesla? Now, the second thing is this a good business? Is Tesla a good business? What are the key success factors for this business to do well? Anyone has any questions in between, please ask me, and we can actually do much better. Then second is define the market opportunity. How big the market is for, say, electric vehicles. Is it $1 trillion market? Is it a $2 trillion market? Is it big enough to have a lot of competitors? That is one thing you do. Then who controls industry pricing? So now, for example, in the electric vehicle industry, Tesla is close to number one. So they can control industry pricing. They can set the bar up here. So anyone who prices lower than them or higher than them has to decide whether the type of features they give will be good or bad versus Tesla. So this is very important to try and understand the industry pricing. Are they too expensive or are they too cheap? Are the features good enough relative to price? So all this you will look when you're analyzing Tesla. Then finally comes the business model. Why is the company good or bad and what they do? Why is Tesla so good? Because of Elon Musk. He is a great founder. He's doing really well. He literally sleeps in the factory. When there's any problem in the factory, he's the first one to go and solve issues. So that's very important to see how the founder is, and is the company good or bad, and what makes the company good or bad. And obviously in Tesla, it's Elon Musk. Can Tesla sustain their growth rate? Can they actually keep growing at the pace at which they're growing? It's very important to try and analyze. Are they growing by buying other companies, or are they growing by themselves? That is, their own profits. And finally, you should be able to, easily describe the whole business to a 10-year-old. How does Tesla make money? From where they make money? Do they make money from their cars, or do they make money from software? So for Tesla, for example, does anyone know how do they actually make their money? Why is Tesla profitable currently?
Because the car market currently trying to change to electric vehicles.
So where do you think they're making their profits currently? Are they making profits on their cars?
Producing
Current
car.
call lithium battery. They use copper lithium batteries.
So Tesla is not making money from their cars, neither are they making money from the batteries. So when you analyze the income statement, you'll actually know where they're making money from. They're making money from something called carbon credits. So every company gets something called carbon credits, wherein if they're doing something good and they're not polluting, they get carbon credits. So Tesla is not making money from their cars nor from their batteries currently. They're making money from something called carbon credits, which is not a core part of their business. So now all this you will understand only if you analyze their income statement, in detail. So what I showed you before is just a brief, but you actually have to go in detail and try to understand whether the company is making money or not on their core products. So that is one thing, you really need to see. And valuations, again, I won't spend too much time on this because this is a topic where you actually have to understand investing, and there are different types of valuations that you use to value a company, whether the value
Again,
for different types of companies. And finally, you go on to the risks of every business. What is the biggest risk in Tesla? Anyone has any guess what is the biggest risk in Tesla?
no.
I think the biggest risk in Tesla is Elon Musk dies. If he dies, there's no one else to run this business. So you really need to understand what are the big risks, and you have to go beyond the business. Elon Musk, he goes on a space flight. What if he dies? What happens to the business? Who will run the business? As we all know, Elon Musk is a temperamental guy. He can fire anyone in a second, and he can also do wonders. So that is one risk in Tesla. What is the biggest risk in Amazon? Someone eating up their market share, a better player coming in. So you really need to understand holistically any business that you're looking at. And this is, how bad could it be? How bad can it get? How can Elon Musk screw up the business? How can Jeff Bezos screw up his own business? These are some things you have to actually think as a business owner and try understanding, how can these guys actually screw up their own business? And this is ultimately the biggest risk. How can Elon Musk screw up his own business? Start firing everyone. Then no talent comes into your company suffers. That's one thing. And then finally, coming on the source of information, how can you understand about a company? So every company releases something called an annual report. In US, it's called 10K, wherein they detail the whole of last year and what all they have done and what all they plan to do. So this is actually what we do as analysts. Our whole day or whole year is just spent on reading. We read annual reports. We try understanding what the management is saying. What is Elon Musk saying? What is he saying about the past? What is he saying about the future? What is his perspective on the electric vehicle industry? How is it going to grow? So that's what we try understanding, and then we try putting it in our numbers. Letter from Elon Musk, what is his objective, his goals. Newspapers are one of the most important things to try and reading. You should try reading newspapers as much as you can. I personally read almost 6 newspapers every day. I get up by 5:30, 5:45. I read 6 newspapers every day. And I've been doing this at least for the last 3-4 years. And I started reading newspapers when I was 16, 17 years old. And not like, your gossip columns, guys. You need to read like business news so that you actually understand what's going on, around you. And you can have conversations with people. I know you like, talking about, say, film stars gossiping, but that adds no value to your brain. So it's very important to try and understanding different businesses and business newspapers. And for the international, to understand international part, Financial Times, Wall Street Journal is the best. And our college personally gives us a Financial Times subscription. I don't know if they give to you guys, but you also check. And for GMB guys, we get a Financial Times subscription that we can read throughout. And it's very important to try getting as much international information as possible. And finally, brokers reports. These are just reports that are published by different people about companies. So, for example, there will be a brokerage called, say, Goldman Sachs. Everyone's heard of Goldman Sachs, Citibank. So these companies come out with reports that provide in-depth views of companies. So they'll come out with a report on Tesla. It will be 30 pages long, and like we have to read that to try and understand what is their view on the business. And as a research analyst, if you're preparing a stock pitch, it's very important to try reading as many brokerage reports as possible, because that will give you a holistic perspective. Because if you're pitching a company to someone, you really need to know the ins and outs of it. And if, say, Nitish Jain, he gives you money and you need to invest that money in stocks, he'll ask you why you investing in this business. So that's where you get information from brokerage reports, annual reports. And for example, SP Jain, Mr. Nitish Jain was working in a brokerage before he actually started or worked in SP Jain. So he actually has very good information about the stock market. So you have a really smart guy in SP Jain itself. And these are some recommended readings that you guys can read if you're actually interested in the stock market. There's this fund manager called Peter Lynch. He's written a book, One Up on Wall Street. There's Joel Greenwald. And if you guys are ever, many of you must be sleeping late at night. If you ever want to sleep early at night and you want to get really bored, you read this book called Security Analysis by Benjamin Graham. You will for sure, within one page, get sleep. And this is a book that many investors swear by. And if you guys really want to read about investing, read this, but at your own risk, because you will fall off to sleep in 2 or 3 pages itself. And yes, so any questions, anything, please let me know.
Will you share the presentations with us?
Yeah, yes, I will.
And to conclude, thank you very much, Ronith. I think you guys can. I think he's opened the floor for questions as well. Really thank Ronith to have a different approach. Every time we read or we talk, it's all about prices, news, and people look at stock markets in such a different way. But having a professional who actually does it and talk about the business and certain aspects, help us shape what we need to look for. So I think really thankful to Ronith to be here, and anybody can, if anybody's got any questions specific to investing or finance, I think go ahead now. Go for it.
I have a question.
Go ahead. Yeah.
How did you start investing in 17 years old?
So, see, I was always interested since I was 16 years old, but I didn't. So in India, you need something called a PAN card to invest in the stock market. And I actually used my sister's PAN card to invest. And I actually had a group of friends who are already, interested in the stock market. So it's very important to have a good circle around you that actually invest or that have an interest in trading. So, these guys, we actually did our own research. So as I told you, I read annual reports, I read brokerage reports, and then based on that, I used to take a call whether to buy a stock or not. And that's basically how I started, reading info, just reading. That's all you have to do, and you'll develop an opinion as you read more.
Okay, thank you.
I have a question. When you buy stocks, do you pick diversification over a single stock, or do you prefer to just buy from a single company over diversification or single stock? Which do you prefer?
So see, when you're young, you have a lot of risk in you. So you can obviously concentrate, say, in 5 or 6 stocks. But as you grow older, as your sums of money increase, you need to diversify. Because if you concentrate in 1 or 2 stocks and one of those stocks, go belly up, they go bankrupt, Elon Musk dies, that whole company goes down. So you really need to diversify as you grow older. But as you start, you can be a little more concentrated. And I don't know if you'll have heard this saying, don't put all your eggs in one basket, but you can actually put your eggs in one basket, but you need to concentrate on that basket. You really need to see what are you putting money in. That is very important. So yes, concentrate as you're young, but as you grow older, you need to diversify.
I have a question.
Yes, go
ahead. Vietnamese investor, they usually use PE ratio to evaluate manufacturing companies, and they use PB ratio to evaluate financial service companies such as insurance, bank, or securities. So what do you think of the usage of different ratio? I'm wondering how do we use the DCF ratio? Like it can be applied to all industry or sort of.
So I like your background, the Wolf of Wall Street. I think is it that one, your background?
Sorry.
What is in your background? I see something. The wolf, is it?
Yeah.
Okay, so what you asked is, there are different, valuations that you can use for every industry. It's different. Discounted cash flow is an absolute valuation that values a company in an absolute way without comparing with other companies. Now, this is one way. The second way is something called relative valuation, where you compare the company with companies operating in the same sector. So for every sector, the valuation you use is different. For manufacturing, it's price to earnings. For financial companies, it's price to book. For companies that are not making any money, it's price to sales. For companies that have very high debt, it's enterprise value upon EBITDA. So your valuation ratios depend a lot on the company you're analyzing and the sector you're analyzing. So you cannot have just one broad brush that says use the PE ratio, because that does not make sense. Tesla, for example, has a PE ratio of 1,000 versus say a Toyota or a Volkswagen that maybe has a PE ratio of 10 to 11. So, just based on that, you can't say Tesla is expensive. You need to look at a lot of other things and try to understand what ratio to use and where.
I have a question. So like I initially want to start investing right now, like as soon as possible. So should I stick to short-term trading or should I go with long-term trading? Because people around me tell me that long-term trading is good, but I also have friends who tell me that trading like intraday trading and stuff like that is better.
See, again, when you're young, you have a lot of risk appetite in you, you have a lot of adrenaline, you're very happy to make short-term profits. See, as long as you're making money, it doesn't matter how you're making money, but you need to make money. So you do intraday, you do short-term, you do long-term, but predominantly intraday, 99.9% of people lose money because it's almost like betting. You're just betting on a stock going up during the whole day. But a stock is actually a business. You're not looking at the business. You're just looking at the stock going up or down. So that is why people don't make money. Second comes to short-term trading. Now, short-term trading, again, what type of analysis are you doing? Are you analyzing the company? Are you analyzing something called technical analysis, where you're analyzing the stock of the chart? So as you're young, you want to do short-term trading. But as you grow older, it goes to more long-term trading. And long-term trading is more profitable because you're actually analyzing the business. Short-term trading is more price-based. So you have to see which one you're good at. But obviously, long-term trading is the best to go. But when you're starting, you start short-term trading. But obviously, always start with small sums of money. Don't start with large sums of money, because you can lose small sums of money and it won't mind. But if you start with a large sum of money and you lose it, your whole confidence goes down the drain. So whatever you want to do, start with small sums. Whatever makes you money should make you happy. That's important. Any more questions, guys?
No problem. I don't have it.
Can we have the slides, your presentation after the meeting?
Yeah,
Thank you.
sure. I'll send it to Aryan. He can send it
And
back to
send it to
you.
everyone. So yeah, Ron, it's a pretty, fine guy when it comes to this, when it comes to temperament and knowledge. And yeah, he's guided us throughout, even past the last semester, and helping us build our portfolio and the knowledge to, roughly make it happen. So huge thanks to Ronald for being here. He actually took time on a weekend to come out and, in the middle of his GMBA program. He's also very close into this new fund that SPGen is starting, and what the structure is and everything. There's a lot of expertise which has come in from Ronith. Huge thanks to Ronith for coming. And even I have another question. When it comes to investing in India, right? It's right now the market is stretched, right? Sensex 60,000. We're in this elusive area right now where everybody is making money. So, and even with the cryptos, right? I don't know, it's some euphoria, when it comes to most asset classes. Do you see the music stopping, or you think it's going to go on for a while? Because nobody can tell. But do you think the music, like, people are dancing a lot more now?
See, India, or actually globally, what has happened is millions of people have entered the stock market in the last 2 years because they were just sitting at home and doing nothing. So that's one way where everyone has made money in the last 2 years. Historically, when people make a lot of money, say in the last 1 year or 2 years, the music usually stops. So the market usually corrects from there. But you really need to, as I said, you really need to analyze each company in individually, and don't look at the market, because the market will go from overvalued to undervalued. The main thing for anyone is to understand the business, understand what the company is doing, what are the risks in the business, how can the company do really well going forward. So there are very smart investors, like I think Aryan knows Saurabh Mukherjee in India. You guys should really read his writings, what he writes, Saurabh Mukherjee. That guy does not look at the market. He just looks at companies. He looks at the cash flows. That's all you have to do. You have to ignore the market noise, ignore what central banks are doing, what is the Fed doing. Just analyze companies. That's all you need to do. Analyze whether the company is undervalued and overvalued, and buy or sell. And as college students, all of us want to spend money, right? So if you can actually make money by trading and investing, you don't need to keep asking your parents for money, and that's the best way to go forward. That makes you financially independent very early. Like for example, for me, since I'm 17, 18, I don't need any pocket money, because I can actually invest on my own and make money on my own. So it's very important to analyze companies, and it will actually help you going forward as well, because when you get a job from a company, you need to actually analyze if the company is doing well or not. If you get a job from a company that's almost bankrupt, and you don't know it's bankrupt, you lost a job in maybe 10 months. So you really need to know all this, and it's very important for you guys to analyze.
I think that concludes it. If anybody has any final questions, and I think, yeah, a huge thank. Go ahead.
Yeah, I have a question that you use which approach in fundamental analysis. Like I usually use a top-down approach, and Dr. Cherry said it's not a good approach. And what do you think? What approach that you use?
So you're asking which approach should you use to okay,
sorry,
so
can you? Okay.
you're asking about top-down approach to analyzing a company.
Yes, I use top-down approach.
Okay, so for everyone who doesn't understand what top down is you look at a country, then you look how the country is doing, then you look at the sectors that are doing very well in that country, and then you analyze a company. This is called top down because you're starting from the top. So what she's asking is, should we do top down or something called bottom up, wherein you start with a company, then you look at the sector, then you look at the country. So these are two, contrasting opinions that people have. So ideally, for starters, everyone should do a bottoms up investing. Whichever country you're from, you should actually analyze, sectors and companies in that specific country, and then you should go towards, say, top down approach. So it's very important to always start at the basics, the bottoms up, start with the company, then the sector, then the country. And again, guys, so there's something called, you guys will learn something called technical analysis as you go forward, and fundamental analysis. But if you see the billionaires in the world, there is no billionaire who's a technical analyst. There is no billionaire who looks at charts and invests money. It is all fundamental analysis. Look at how the company is doing, and you make money based on that. Warren Buffett, anybody, Charlie Munger, George Soros, all these guys are bottoms up investors. They look at how the company is doing, and then they will look at the charts. So don't get influenced by technical analysis, because it's the most easy thing to do, yet it's the most difficult way to make money. So that's one thing you guys should keep in touch and in your mind when you're looking to enter into the stock market.
So you prefer bottom-up approach? Okay, thank you.
Bottom up, yes. Absolutely.
Yeah, okay.
I have a question.
Yes, go ahead.
What stocks do you invest in, like US, India?
So see, I stick to my expertise. It's always important. I stick to only India, because that's one market which I've been tracking for the last 6 to 7 years. So it's always easier for me to invest and trade in the Indian market. And second thing is, if I'm trading in the US market, I need to stay awake 24/7, which I'm not going to do. So it's always better to choose one market, become an expert in that, and then move forward.
I also have a question,
Yeah. Go ahead.
but I want to first thank and appreciate for you taking your time to share us this valuable information today. As you were saying, how you started investing when you were 17, could you please walk us through on how much amount you started, investing in the stock market? You just mentioned you started investing in the Indian stock market. So how much, what was the minimum amount to start investing at that age?
So, okay, so I'll tell you how I got the money. So in India, there's something called, I think when you're young, when I think Jewish people have something called the bar mitzvah, where you get money. In India, you have something called the thread ceremony, where you get money from your parents, from your relatives, as you attain teenage, or you're 14, 15. So that's around, I think I started with around 1,500 US dollars. And when I was 17, 18 years old, and I started investing. So there's no minimum amount to invest. You can start with $20, $30, $40. The main thing is to start. As you start, as you gain confidence, you will put in more money. You make more money. Your parents will obviously put in more money. So it's always important just to start. The amount does not matter. Just start. That is the most important thing.
That's it, probably.
Any more questions, guys?
I think that concludes it. Amazing questions. Thanks, Ronith, for coming in. Hopefully, we can have you again for an advanced session where, something which is way more, something like a DCF, or, we can actually open up a company together. And then, a lot of people can learn, basically what the thought process is. Because, yeah, it's been actually amazing. Today's 1 hour. Huge thanks. I think,
Thank you, guys. Thank you so much.
very
And
much.
guys,
Thanks for everyone
again,
coming.
I'm sorry I keep on repeating, but start investing as soon as possible. It's going to be very helpful for you guys going forward.
Perfect. So yeah, quick outlook. There's also a fund that we're starting, an SPGen fund, which is funded by SPGen. There's a bunch of mentors and professors that are also on the team, and we have a set of research analysts, and we'll actually sit together and, just how Ronith mentioned, find good companies and, understand the businesses and then hold them for long periods of time. Thank you so much, Ronith, for everyone for coming, and yeah, the session's over.